everybody, and welcome to the Fred Report conference call for December 16th, 2010. Unbelievable to say December 16th, 2010. It seems like just yesterday it was December 15th. Sorry, that was a bad joke. Anyway, we will get right into things, guys. Don't want to take up a lot of time. I know it's a holiday season. The first thing to mention is the market is still trending up, but it is acting a little tiny weeny bit weaker than I would have expected. I actually thought we were going to see the market really sort of take off to the upside here as portfolio managers that had been lagging the market were trying to get in before the end of the year. And instead what's happening is we're sort of drifting upwards. We're still hoping for higher prices into the end of the year, but we do note that a lot of our condition indicators, our put-call ratios, our investors' intelligence percent bears got down to 20.5. Our high-low indicators are weakening, and the AD is also weakening. That's advanced decline. So what we are seeing here are signs that after this rise is over, and we think, as I say, we've got another 2 weeks or so on the upside, that this market could come down rather sharply in a correction. We are looking right now at the 1180 to 1150 area. In other words, not huge, back to where we were at the beginning of December, end of November sort of thing. But we are seeing that as a very definite possibility now. In fact, it would surprise me a little bit more if we did not have that correction than if we did. And the only question I have is, do we start it sooner rather than later? A number of people have asked about the bond market. The TLT has come down. Rates are definitely going up here. We don't think there's going to be a gigantic rise in rates from here. We actually think this move in the bonds is just about over. Major support on the TLT is in the 88-89 area. Currently we're at 91.13. There are layers of support between 92 and 88, and we're right in the upper end of that. So, you know, rates may sort of stabilize in here. That's my guess. But we're not going to see, and I think ultimately we will see, by the way, next year money come out of bonds and into stocks. But I think we're going to get that little bit of a pullback first. We're looking at the commodity markets, and I guess the first thing I would mention is the DBC is in great shape. If it can get above 27, it looks like it's going to test 31, but that's not being led by gold. Rather, it's being led by oil. Gold looks to be in a little bit of a range, say 140 to 130 on the GLD. We did have some very high bullish sentiment numbers on gold on the Market Vane poll about a month ago, and that often, not all the time, those Market Vane numbers, we don't really trust those, but it is a sort of a nice indication. Those Market Vane numbers have been good when they get above 80 at forecasting at least a slowing in the rise of gold. If the USO, on the other hand, can make it through 39, and we see that as being very definitely possible here, if the USO can make it through 39, we're going to probably test 42, 43 on that, and that I think can run through January even if the market pulls back. So we think the commodity markets are attractive. Commodity stock areas are attractive, like energy and such, even if the market pulls back. One of the other things we've noted, by the way, in stocks in general, and it's something to watch, is we've seen a lot of the junk rally, stocks that have been lagging all year. One of the best examples of that is McDonald's has been a leader all year. It's sort of gone into a consolidation. And Home Depot, which was sort of in a